Stocks ending the week with a major rally, but the Dow and S&P could close out December with their worst performance since April. Joining us now is Olaolu Aganga. She is the U.S. Chief Investment Officer at Mercer. Olaolu, great to have you back here on set. So for 2025, you think U.S. stocks do pretty well, but not as well as Japan?
Yeah, I mean, look, right now we've seen just even the equity flows for November, what is it, 140 billion in U.S. stocks is the highest that we've seen in 20 years, right? So 350 billion just year to date. With the incoming administration, there's a lot of enthusiasm for the U.S. market. It's clearly an America First type of agenda that we've seen. Personally, from a tactical asset allocation perspective, we are somewhat neutral. But we've been looking for opportunities that we can invest in for prolonged periods of times, more themes, thematic opportunities that can persist through some of the noise that we're seeing. So a couple of examples, AI, of course, we've seen that happen, but AI driving productivity growth. So natural language processing, perhaps machine learning. So partnering with private equity companies in a deal environment that's conducive for that to be able to invest. The other aspect that we've been looking at as well, another theme, it's more called the security of everything. So whether it's cybersecurity, in this geopolitical environment, anything that can protect supply chains. So investing in those types of companies. But again, it's more prolonged.
At what point do the Trump administration's policies cease being noise, right, and start being something that you can really invest based on and find real advantage? How do you figure out when that moment is?
They will have to come in and we have to see what can actually get enacted. The number one thing that's been a big focus is the tariffs, right? So potential 60% on China, 10% on a number of other places. We've seen the market performance of China, even we've seen the one-year rates dip below 1%, right? Like that we haven't seen in an incredibly long time. So tariffs is one, but then that also has bigger implications, so potential inflation, right? So 2025, we're expecting significantly more rate cuts now. If we see the median dot plot, it's like 2, maybe, right? So 50 basis points. But if all of these things can be enacted, it's the fallouts from tariffs. And what does that mean? Interesting.
I mean, you just mentioned that you're tactically neutral. Why? And how much of the policy noise does that hinge on and would change that neutralness?
So tactically neutral because of the uncertainty. And I mean, debt ceiling aside, right? So talk about uncertainty. What we've done is just taken a little bit of a step back to see, okay, if rate, 25 basis point rate cut that we've just seen, potential 50 basis point by the end of 2025, what other opportunities could we have? One would assume in a environment where rates are going lower, it would mean that we would start looking longer out in the curve, maybe looking for more fixed income opportunities there. We're not seeing it. Our clients aren't seeing it. In the longer part of the curve, it's still more the corporate pension defined benefit plans, and those are hedging liabilities. So those opportunities haven't opened up quite yet, despite the fact that rates are going lower. So that's where, we're waiting to see how things just really filter in.